Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody. Welcome to this Tuesday, November 28th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next, I don't know, maybe about 30 minutes or so, walking you through what I'm seeing here, but pre-market action, lead you right up to the open. Haven't done this now for about a week. We took off last Wednesday and Thursday because of the holidays. Hope everybody had a great Thanksgiving holiday. Hopefully your travels were safe, and now we're back in it. Getting ready to wrap up November. It's hard to believe we're almost in December of 2023, about ready to say goodbye and welcome in 2024. Seems like we just started the year. I don't know, maybe it's just me, but I feel like as I get older, years go by a lot faster. Just ready to put some brakes on here. Anyhow, looking at futures this morning, Dow futures down 26, S&P futures down 8, NASDAQ futures down 30. On a percentage basis, NASDAQ and S&P both down around 1/5 of 1%. One thing I think you've probably noticed in recent sessions, where's the volatility? You know, why are we, it seems like pretty boring action during the day, not really doing anything. Well, I mean, that's kind of typical. We're going to talk a little bit about the volatility index a little bit later in the show. But when the market's moving to the upside, the VIX goes down and it does start to get pretty boring. And those who are expecting big moves to the downside or even big moves to the upside can get a little impatient, because the market, again, when the volatility index drops, we do tend to see some pretty, I don't know, just know what the right word is, but just very quiet kind of trading. Not really a whole lot going on during the day. Maybe at the very open, we get a little bit of movement one way or the other, a little bit of big moves. Then it kind of calms down. We're just a pretty quiet session after that. Anyhow, let's go ahead and move on, take a look at what's going on the charts. I do want to mention also that crude oil prices just up a little bit above $75 a barrel this morning. 10-year Treasury yield up 2 basis points, 4.41%, clearly still in an uptrend. We'll look at that chart in just a second. But first, let's get into the Dow Jones, which fell 57 points yesterday. S&P 500 down about 9. NASDAQ100 down 20. Mid caps down 3. Small caps down 3/5 of 1 point. And when we look at that on a percentage basis, actually the small caps losing 3/5 of 1 point, actually being down about 0.33%. Is or was the worst performing index yesterday. That is until we look at transports. You can see transports took a pretty big hit yesterday, down 1.26%. I'm going to show you a chart and a little bit on the transports, though. I see a pattern. Maybe I should ask if any of you all see a pattern. I'll look at the comments. But do you see a pattern on the dollar TRAN chart? Maybe pull it up on your own screen, or I'll take a quick look at it. This is what I'm looking at here on the transports. Just let me know if you see anything on that chart or look on your own chart. Type it in the comments. I'll talk about it in just a couple minutes. Real estate leading from a sector perspective yesterday, gaining a little bit more than 1/3 of 1%. We had utilities gaining about a little less than 2/10 of 1%, and discretionary, same, a little less than 2/10 of 1% higher. Looking at the industry groups, steel, your best performing industry group yesterday, gaining almost 2%. Publishers, that's found in the communication services area, publishers up 1.45%. And then you've got the DJUSHV, it's heavy construction, heavy construction, which also rose a little bit more than 1% yesterday. So pretty good action. You can see all three of these groups, by the way, starting to show, movement back to the upside. Even the heavy vehicles, it seems like now we've broken out to almost a 2-month high. This group has been under a lot of pressure since that July top throughout the correction, but starting to bounce back. Looks good heading into December at least. But overall, I would say it was just kind of a ho-hum kind of a day. I mean, when we look at the AD lines, which I like to look at, the Dow not really as strong, but look at the S&P and the NASDAQ100, both breaking out the new highs on the AD line. I like that. Mid cap, small cap still struggling in that area. Maybe we see some pickup in December, which tends to be pretty good period for these areas of the market. But November tends to be pretty good for them too, and not really showing a lot on a relative basis. On an absolute basis, clearly we're going higher. I think all the major indices are in an uptrend, even the transportation group, which pulled back a little bit more considerably yesterday. All of these look to me to be in uptrends. But let's keep moving. Let's go in the 10-year Treasury yield. 10-year Treasury yield, as I mentioned, talked about the head and shoulder formation. That started with a negative divergence on the PPO. Check out the yield moving higher, PPO moving lower. That is a negative divergence. That doesn't mean that that's the ultimate top, but it can mean that's the ultimate top. And so you watch for patterns to develop. Here we come down. We set the right side of a neckline. We get a little bit of a move back up, test the 20-day, and now break down. You can see that big red candle where we broke back down below 4.55%. That was the neckline. And we have continued to weaken. I see the Treasury yield continuing to move lower. I think we would need to reevaluate that if the yield were to get back up above 4.55%. That would be the first sign that, hey, maybe I need to reconsider. Maybe the rates are going to go up further. But for now, you got to play this as though the rates are going lower. And that's usually a good sign for our U.S. equities. S&P 500, putting in what looks like maybe could be the right side of a neckline. If it is, it's upsloping, which would be good. Any kind of a pullback, put in a right shoulder, and then a breakout above 45.50. If you play that measure or that pattern, that measurement from 45.50 down to 4,100 is what? 450 points. Do you know what 450 and 45.50 add up to? 5,000. That would be the measurement. If this pattern, we may just keep going higher, may not have anything, there may not be a pattern that develops. Right now, what we can see for sure is that we had, during the correction, a down channel. Really easy to see. This is how I draw them. So I will take, usually, I'll go up here, grab the top line on a downtrend. The tops are established right there. And then I usually will grab that and drag it one way or the other. So here it doesn't quite line up, but one thing if you just kind of change it a little bit and say, okay, how about if we do this? Get rid of that line. And maybe we'll get just, oops. Get that set up. There we go. And then when you kind of drag this right here, kind of get, that looks a little bit more like a channel. Now, keep in mind, I just showed you two different channels. This is very subjective. How you draw the lines. Do you connect the highs? Do you connect the closes, the opens? I mean, the lines are going to shift a little bit. I don't care which way you draw the lines, though. Clearly, we had a breakout. The downtrend is over. We're moving back up, ready to challenge the high that we saw back in July. By the way, we've got Market Vision 2024 coming up. You're going to want to mark your calendar 4 years in a row. I've given pretty good prognostication of where the market's going. Back at the beginning of the year, I said the end of the year, S&P 500, 4,600. We're sitting at 45.50 right now with a month to go. And there, some of the earlier years were even better. 2022, I called cyclical bear market before it even started, or basically as it was starting. Anyway, mark your calendar for that. But what I'm seeing here is just a breakout above this down channel. We're trending higher now. Watch that rising 20-day, which is above the 50-day, which is also rising. PPO looks great. AD line down here on the S&P 500 back up to new highs. I mean, I don't know really from a daily perspective what's not to like here. Yeah, we got to get through 4,600, but that happens anytime you get a pullback. You got to go back through prior highs. We've been negotiating one high after another, one key area of resistance after another, and now we're within striking distance of that 4,600 level. Let's keep moving. NASDAQ 100. Now, one of the reasons why I don't know that we're going to see inverse head and shoulder pattern show up on the S&P, and why I think maybe we just keep going higher, because that's what the NASDAQ 100 did. Here's your leader. NASDAQ 100 not only has broken out and taken out that first reaction high back in late August, early September, but it's also cleared the July high. We've actually gone through the July 2023 high. The NASDAQ on Thursday of last week set a new 52-week high. So those large cap growth stocks, which have been drivers in the stock market for quite a while, are back at it again. They're the ones that are leading this move to the upside. I find that to be a powerful bullish indicator. Others, like to poo-poo it. Only thing I can say is look at the chart. I mean, those who are poo-pooing it have been poo-pooing it all year long, and the market keeps going higher. So at some point, you got to say, uncle, and understand what's actually happening in the market. Anyway, but that's the NASDAQ 100. Looks good. How about small caps? Small caps look better, but they don't look good on a relative basis. I mean, you have a choice to make. Do you want to invest in the QQQ? Do you want to invest in the IWM? Do you want to invest in a 20-cent stock on the over-the-counter exchange? I mean, all of those different questions are up to you. I'm going to stick away. I'm going to definitely shy away from that last one. But yeah, I mean, I can't get overly aggressive in the small caps until they show relative leadership. They're showing absolute strength. We did break out of the channel. We did get the gap up with the inflation. We've been holding that. We're above the 20. It's above the 50. 50 hasn't turned up yet. 20 clearly is moving up. PPO looks good, but AD line's weaker. So you can definitely see some flaws in this chart that we don't see in the NASDAQ 100 or even the S&P 500. So they're not quite showing us what we want to see yet. I do like a lot of these hollow candles in here, though. Even yesterday, it looked like early in the morning. I'll show you the intraday chart from yesterday. I mean, we had this big move down. First 15 minutes, it looked like this group was completely collapsing. And then 15 minutes later, it's like, nothing really happened. We're right back trending higher again. And when you take that intraday 5-day, 10-minute chart, and then you plot that action on the daily chart, I just see a move up, maybe a bull flag, move up, sideways action, maybe an ascending triangle, kind of equal highs coming across here, right at this high and this gap resistance with rising lows. Kind of see that with me? I mean, if we break above 180, this is a measurement that could take us up another $10 to 190. And 190 is what I was talking about earlier on the IWM. I could see it moving up. But if we get up there to 190, where's the QQQ going to be? I don't know if it's going to, that's going to be the interesting part. Does the IWM take over some leadership? At least for a period of time, maybe a month. So far, that hasn't happened. The way, when I say relative leadership, all you do is IWM, whatever you want to compare it to. QQQ. Look at the yearly chart. I mean, it's pretty clear to me IWM has been lagging throughout the entire year. Sometimes worse than others. Occasionally we get a little bit of a pop. July, we got a little bit of a pop there on a relative basis. Second half of September, outperformed. Coming off the low in mid-October. So far, we've been outperforming. I want to see a little bit more, though. All right, I'm going to look at that transports. Let's see. Head and shoulders. Ding, 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 ding. Reverse head and shoulders, even better. Reverse trans head and shoulders. Yes. Everybody talking about the head and shoulders. That's exactly what I see. So let's pull this chart up. Transports moving down. You can see during the correction, 3 months straight down. Nobody can deny that. I mean, price action tells us pretty much everything. No lying going on this chart. But let's annotate this, because what I look for off of a downtrend, I look for patterns. I look for anything to help me in the market. And so what I'm seeing here is this bounce right here, setting up the left side of a neckline. This coming back up, establishing the right side of a neckline. In the middle, or the left, over here on the left side, you can see a left shoulder. This pullback, maybe we hit the 20-day. Could be a right shoulder. When you're coming down, just like when you're going up, let's go back and look at that 10-year Treasury yield. Left shoulder, neckline, head, neckline, right shoulder, boom, to the downside. All you're doing when you're calling a bottom, that's calling a top. When you're calling a bottom, it's just the opposite. Instead of the topping head and shoulder pattern, you have a bottoming head and shoulder pattern. And this one on the way down prints the left shoulder and you move higher into the neckline. Then you go lower, you come back up. Normally in a downtrend, what happens? Here's your high, lower high there, lower high here. So when you go down here and you bounce, first thing you're thinking is probably lower high and we're going to roll over. Well, all of a sudden we get some renewed strength. And now instead of putting in a series of lower highs, now we're coming back up and we're testing a prior high. That's the first clue. When you all of a sudden don't roll over and you go back up and test a prior high. Now that is showing good signs, but we don't have any kind of confirmation. I wouldn't be jumping in because I see that. You know, when we get a little bit of a pullback, I mean, again, back down maybe below 14.8, maybe even closer to 14.6. If we were to pull back there, I think the pattern would be much more symmetrical. I think a lot more traders would see it. I mean, you can see in the comments, folks saying, hey, reverse head and shoulder pattern. I mean, they can already see it. So imagine if we go back down, hit these moving averages, and then come back up and break out. What are technical traders going to do on that? Technical analysis is all about predicting what's going to happen or what you think's going to happen based on what already has taken place, based on all the other signals, the below the surface signals that I like to talk about. All those things are important in calling the market. But the clearer this pattern becomes, the more likely when we get a breakout, you're going to see traders act on it. And that's why, you know, too many of these patterns, I see people overuse patterns. I see, you know, upsloping necklines. Everybody always wants to call a topping head and shoulder pattern. And I'm like, okay, first thing that is helpful is to see a negative divergence develop first. Then you want to see a neckline get established that is actually downsloping, like on the TNX. Negative divergence came down. Look at where that tail went. It went below that low. So it's starting to give you a feeling of, hey, this thing is starting to roll over. And then if you get a weak bounce like we did and one more push to the downside, that's where you get your confirmation. So as I'm looking at the transports, what I'm thinking is that, okay, we came up, we didn't exactly get that higher high on the right side. So that is one thing that's missing here. We didn't get a positive divergence. So I'm not going to just jump into transports and say, here we go to the upside. I would rather work on areas that have already shown patterns and already convinced me that we're in uptrends. This one's got some work to do. So it's not like I'm just going to go jumping into transportation stocks here. However, if you get that breakout, that would really start to make things look a little bit more bullish in my view on this chart. All right, let's talk about the chart of the day. First, actually, no, let's stop on the chart of the day. Let's take this transport thing a little further. Let's say we get the breakout in the transports. You might say, okay, what do you do then? Can't buy the transportation index, right? Well, you could buy an ETF like the IYT, which is an ETF that tracks transportation. But another thing you could do is go over here in the Your Dashboard at Stock Charts under Member Tools, scroll down till you get the summary pages and pull up scooter reports. Now, this is automatically defaults with large cap stocks and the highest scooters. If you type in something like railroads, it will give you the large cap railroads in order of scooter. So maybe you decide you look at the railroad chart and you like the railroads. Okay, here's your leader. Now you might say, well, give me a mid cap stock. All right, well, I think they may all be a large cap. I think all the railroads. What about trucking? All right, large cap, SAIA. There you go. How about small cap? You get small cap, you can look at some of these. I would look at volume, make sure that you're getting enough volume. You want to make sure your stocks are liquid. Mid caps, you can see the volume a little better here. ARCB, ARC Best has a 93 scooter. All of a sudden, transports break out. I'm going to start looking for some of those. That's one way to do it. There are others, but that was one quick way. All right, let's keep moving because I'm going to run out of time. Fall special. Want to talk about that because it's part of what we're doing right now. If you like what we do right here on this YouTube stream, you're going to love our service. If you haven't already tried us, give us a shot. 30-day free trial. Our fall special runs for another week or so. Actually, I think it ends this Sunday at midnight. But if you start your trial now and you like what you see and you really like our service, you can get the best deal of the year and you don't lose your 30-day trial. It's not like you have to make a decision in 5 days and then give up your trial. Even if you decide, hey, I like this, I'm gonna jump in on the annual fall special, you'll still get the rest of your 30-day free trial first. And then the deal you'll get, and if you click on this, you'll see we have a 1-year deal. You pay our regular $997 annual rate. We'll give you 2 free bonus months. 2 years, we'll give you 6 bonus months. And if you pay out 3 years, we'll give you a whole year. That's the way you're going to get our monthly cost down to its lowest. There's $62 a month on the best deal. And normally the monthly rate's $147 a month. So you can save a lot of money. If you like what we do, you commit to us. I promise you, we commit to you. Our members can tell you, we commit to our members. We give so much research above and beyond just saying what we think the market's going to do, or we like these stocks for these reasons, or here are our portfolios. We do a lot of education, provide a lot of guidance throughout the year. Anyway, check us out. At least do the 30-day trial. If it's not for you, hey, completely understand. We're not for everybody, but I think you'll like what we do. And then just keep in mind, this goes through Sunday. All right, chart of the day. So it's almost December. Talked about that right at the opening of the show. Can't believe the year's almost over. Stock market, there's a lot of seasonal patterns that we need to be aware of. One of those seasonal patterns, believe it or not, is that when you get to the 3rd month of each calendar quarter, so January to March is one calendar quarter, the 3rd month is March. You go to April through June, 2nd calendar quarter, June is the 3rd month. And then you've got July through September. September is the 3rd month. And then you've got October through December. December is the 3rd month. The reason I'm pulling up these 3rd months, this is the non-durables, non-durable goods index, DJUSHN. It's part of consumer staples, which is a defensive area of the market. Stocks in this area, consumer staples, and in particular, the non-durable goods, these stocks tend to pay dividends. They're dividend payers. They're defensive, value-oriented kind of trades. I want you just to look at this chart. And I guess if you've already gotten our EB Digest, I don't know if it got sent out yet, type in, if you see anything on this chart that looks peculiar, and I'm talking about those 3rd months of each calendar quarter, just take a second and look at that. I'll take a look at the futures here again. Right now, I mean, not really much change from where we started. Dow futures down 11 right now. S&P 500 futures down about 8. NASDAQ futures down 33, which is about 0.2%. Crude oil is up now more than 1%. It's up 96 cents to 75.82. So it's getting closer to $76 a barrel. 10-year Treasury yield still up 2 basis points, 4.41%. All right, so I'm not seeing any further comments, but what I want to just point out is if you look at the 3rd month of each calendar quarter, add up those average gains. This is over the last 10 years. This is during the bull market that we've been enjoying for the last decade. Add up March, June, September, and December. I'll do it. 1.6 and 1.1 is 2.7, plus 1.3 is 4.0, plus 3.1 is 7.1. So I'm counting and adding this up to 7.1. The non-durable goods index outperforms the S&P 500 by an average of more than 7% in those 4 months. Add up the rest of them. Look at this. Minus 2.4, minus 1.8, that's 4.2. Minus 1.4, 5.6. Minus 2.5, that's 8.1. Minus 0.5, that's 8.6. We gain 0.7. That takes us back to minus 7.9. 0 still at minus 7.9, and then November minus 1.7. That's minus 9.6. So the first 2 months of every calendar quarter, this particular index and many value-oriented areas of the market take a backseat to growth. The third month of each calendar quarter, these groups come back to life. And in my opinion, it's all about earnings. When do earnings generally get reported on most companies? Starts in first month of the quarter, and basically goes through the second month, but definitely through the middle of the second month. That's where we have that 4-week period is where we have most of the earnings coming in, certainly the big ones, most of the big companies. And right before that, of course, we have pre-earnings run-ups. So that's why you're getting strength in aggressive areas the first couple of months of each quarter, but the defensive areas take a back seat because growth is all about earnings, right? I mean, that's why they get priced so much higher than value stocks, because they're based on future earnings. All those future cash flows being discounted back using current interest rates. Value stocks, their earnings are about the same no matter what. I always, kind of joke around, but it's true. When you're in a bull market and you're having the time of your life, your 401ks are exploding, do you go out and you buy more soap? I mean, no. Do you buy more lattes at Starbucks? Maybe. Your discretionary dollars, you spend more when you feel wealthier. These staple stocks, you're going to buy the same amount, no matter how good you feel about your 401k, no matter how good you feel about that last raise you just got in your job. Doesn't matter. What matters is you still need soap, and you need about the same amount every day. I mean, I get excited, but I don't go taking more showers because maybe if I get really excited because of the market going up, maybe I sweat more. Maybe I would need more showers. But I think you get my point. These stocks come back when the other stocks rotate. When we see rotation out of the stocks that led us for 2 months, that's when these come to life. Anyway, just wanted to point that out. You really need to be aware of that. Let's talk about the VIX. So I did an article on Sunday. If you haven't read it, you've got to go back and read it, because I honestly did all the calculations over the holiday weekend. See, while everybody else is eating a lot of Thanksgiving food and, putting on weight, I'm starving myself while I'm doing stock market research. That's not true, by the way, but I do a lot of research in my spare time. It's just a hobby. I would do it whether or not I had this service at EarningsBeats or not. I love studying the stock market. Anyway, what I did is I went back and I looked at the VIX, and let's go back the last 11 years through this bull market, and the VIX is just going up and down, right? No real. Well, I mean, we have trends from time to time, and I always like folks who talk about the VIX moving up through a moving average or something. It's like, who cares? This isn't a trending. This isn't a stock. This isn't an index that trends over time. This is a one and done. I mean, look at these moves. Boom, done. Boom, done. Boom, done. Boom, done. Boom, done. Boom, done. They go up and they come right back down. Don't use technical indicators with the VIX. I think that's a huge mistake. All this is doing, it's giving you a little bit of kind of like an eye into what the market makers think of the market. Market makers are the ones that price options, and it's the price of the options that dictates the value of the VIX. So in essence, if you follow the VIX, you're kind of following what market makers are telling us. All right. So what I did was a study. I got to bring this article up. You got to go back and read this if you haven't already. Right here. What are the chances of a market crash? This indicator says 0. And I noticed that it was pretty well read over at Stock Charts. Right here. Actually, right here. So moving up on the favorites list or popular articles. And it should be a popular article. I'm telling you, everybody should read this. So what I did is I broke down the VIX. You see this? I broke it into shaded areas. What happens to the S&P 500 on the days when the VIX closes above 20? What happens when the VIX closes from 17 to 20? What happens when the VIX closes from 13 to 17? And what happens when the VIX closes below 13? So 4 different scenarios, and look at the difference in returns. These are annualized returns, looking at every day. So every day that we closed above 20, I pulled the S&P 500 to see how the S&P performed that day. And this was the result. If you're above 20 on the VIX, every one of these days that you see, the annualized return for all of those days, minus 36%. Question, do you want to be in the stock market if the VIX is over 20? If you say, yes, I want to be long, then I want you to explain in the comments why you want to be long. You do not want to be long. When volatility is picking up, and I always say this, the higher the volatility, some traders get excited. They think that's the time they're going to make a lot of money. I've found in my history, that's when I lose a lot of money, because you start trading more on emotion than you do just on, common sense, perspective, some of the things that actually help you make money in the stock market. When you're trading, yes, it's great when you buy Apple and the stock market gaps up 3% the next day. Hey, I get it. Found money. Not so good though when it gaps down 3% and then trades down intraday another 4%, and then you're sitting there with a big loss and you're like, okay, what do? I get out, and then the market rebounds. And then it's just a game. Anyway, you need to know these numbers. 17 to 20, the S&P does a little bit better than it normally does. The average over the last 50 years, last 73 years, since 1950, the S&P average is going up 9% a year. So you can see when the VIX is over 20, the S&P, you're going to see a lot of underperformance. When we're between 17 and 20, we see a little bit of outperformance. When we go from when we're trading, when the VIX is in this 13 to 17 range, look at the returns. Now they're triple what they normally are. And look, when we go down under 13, all these days, the annualized return is 47%. That is 5 times the S&P 500's normal return. So last Friday, the VIX closed below 13. I think it was a big deal based on this chart. So the other thing is, go back here and look, because I also broke down what's the percentage of days that the S&P 500 closes higher when the VIX closes above 20. Only 44% of the time. If the VIX closes between 17 to 20, it moves up to 51% of the time. Now, I can tell you over the last 11 years, and this study went back the last 2,677 trading days, which takes us back to when we broke out above the 2000 and 2007 top on the S&P 500. That occurred on April 10th, 2013. So I looked at every day since 2013, basically saying this is what's happened during the secular bull market. Anyway, the average throughout the 2,677 days, the S&P 500 goes up a little bit above 54%. I think it's 54.1%. So you can see the VIX between 17 and 20, we're getting up closer to that 54% level. It's almost still a little bit below. If the VIX closes between 13 and 17, the odds of the market going up on any particular day in that range, 55.3%. Look when the VIX goes below 13. It jumps to 66.28%. Now, listen, I'm just relaying the facts to you. These are facts. These are historical facts. This is not my opinion. This is not me saying, well, I'm looking at my under the surface signals. These are actual numbers. Do them yourself. You'll come up with the same numbers. So, is it a big deal when the VIX is above 13? I'll let you make the call. Anyway, market has opened. Let's see what we're doing. Get a quick update. We got the Dow down just a tad, S&P down just a tad. We got the NASDAQ now actually up a little. Small caps getting hit though. Small caps down 0.5%. So very similar to yesterday. We'll see if we rebound like we did yesterday. But there's still something going on that relative basis of small caps, and it's just hard. You can't take big positions in the IWM till we start to see some relative strength. I mean, I'm trading the IWM, but I'm focusing more on the QQQ because that's the index right now that is showing the relative strength. When that changes, I'll change with it. VIX right now at 1284. So we did go up yesterday a little bit to 1269. I think that was up 0.23. Now it's up 0.15 today, but still below 13. I'm telling you, if the market just continues to do this boring move to the upside, you're going to see this VIX drift lower and lower. Bears are going to be really frustrated. Anyway, that's the way I see it going from here. Glad to be back. Glad everybody else is back. Again, hope you had a great Thanksgiving. Check out our fall special. It's going to end this Sunday. And make sure you like the video and subscribe to our channel. We'd love to have that. That'll help.
Hey, Tom.
Can't. Yeah.
We've got a couple questions in the chat. Would you mind answering those?
Oh, okay.
Thanks.
All right. Give me a minute.
No problem.
Oh, okay. Well, I see a couple of things. I mean, there's some individual stock questions. All right, I'll take a look at them real quick. I don't usually get into too much of this unless I plan for it. But let's take a look at SHOP. SHOP just made a breakout. I mean, it's trending higher. It's overbought. You could get a pullback at any time. Can't guard against that. But I like the stock. I like what it's doing. I like the breakout. I like the AD line. Shopify looks good to me. Cisco. Cisco, big gap down with earnings. I mean, in this market, with so many solid trades and so many positive setups, I'm not going to jump into Cisco hoping that this is a bottom. I mean, I could argue that it was in a downtrend and we gap down. That's an exhaustive gap and we're going to move higher. But it's not like we're doing it in a hurry at this point. I don't know. I would stay away from Cisco at this point. Market doesn't like it, so neither do I. All right. Okay, question about the cursor. I get this a lot. We're looking into it. I think it's in the software. When I pull my cursor up on my screen, it's huge. I can't make it any bigger. It's already as big as it gets. So it's something about the software we're using when the charts, when it shrinks it down, the cursor just kind of disappears. Maybe I can look because I use a plus sign. Maybe it would help if I change that. Maybe I'll look at it. I kind of like the plus sign, especially, if I use the inspector. I don't know, kind of gives me the crosshairs. Anyway, I'll look into it some more. I'm not ignoring your question, but there is something in the software that's making that smaller, and there's really not a whole lot I can do about that. Any thoughts on 3M? Long term, I'm not a big fan. I mean, I tend to stay away. Here's the chart. I see the charts just came back up. Yeah, I mean, it's trending higher in the short term. If it breaks below the 20-day, I would be out. I think, again, you're going into a month where we tend to see a little bit more strength in value-oriented stocks like 3M. So maybe this continues for another month. Maybe we carry up to the 105, 110 level. I mean, it's not my first choice, but right now, at least it's showing signs of an uptrend. Oh, and I see Tyler commented we've been trying to troubleshoot that option. Sorry, I didn't get down that far before explaining it. But yeah, we'll keep looking into it. But we certainly appreciate your patience. We improved the stream, I think, a great deal. And so hopefully we'll be able to get a better solution for the cursor as well to help out there. Anyway, all right, one last quick update and we'll wrap. Dow's turned positive, NASDAQ's turned negative, small caps weakening here a little bit. Small caps, you can see pretty big drop back down near where yesterday's low was. I think in the grander scheme of things, the market wants to go higher. We could see rotation in December, though, into more value-oriented. Don't be surprised. I'm not going to be surprised if utilities and real estate and consumer staples and healthcare have a little bit better month in December, because historically they tend to do that. Now, if they blow away and we start seeing some other warning signs, then yeah, we'll talk about that. But don't be surprised if we see a little bit more strength in some of those defensive areas. Anyway, have a great day. I'll be back tomorrow for your next Trading Places Live. And please go over to our website and take advantage of this fall special. It's the best deal of the year. Have a great day, everybody. Happy trading.